Hey everyone, we're continuing our property series during the month of August, and today is Q&A day, where we answer your questions. So strap in, you're listening to Mind Over Money. Back in a bit. Okay, before we start the questions, just keep in mind that everything we discuss today is for education purposes only. It's not personal financial advice, and we're recording this on August the 12th of 2022. So things may change by the time you listen to this episode. G'day Archie, how you doing today?
G'day Lachlan. Yeah, doing fantastic.
Hey, before we start, I have a question for you. What do you call a cow in an earthquake?
What do you call a cow in an earthquake?
A milkshake. Hey, it's Friday. We needed a laugh. I'm just practicing my dad jokes again. Also, you actually, for listeners, they may not know this, but you were a financial advisor for many years to dairy farmers, weren't you?
Yep. Not exactly a financial advisor. I was dairy advisor. So I focused on feeding cows as well as, milking cows as well as finances.
Nice. All right, we're going to have to do a whole episode on that one day because I've heard some really cool stories out of your years of being a dairy advisor. So, okay, but today we're on to the questions. We've got a bunch of them, so let's get right into them. The first question we got is from Jamie. It is this: how difficult is it to get a home loan with a major bank if you're a business owner?
It's interesting that they went with the major bank in this question.
I think he was referring to can you only go subprime lending if you're a business owner? Some business owners, they think they have to go low doc.
Low doc, yeah. So there are you do have that low doc option there, but yeah, as soon as you go down that path, you're going to pay a much higher interest rate because the bank will be taking a higher risk, and so they'll increase the interest rate because of that. But look, as a business owner, you can put in a normal application and get a normal home loan, for yourself. And the main thing is work with your accountant and tell your accountant you're going to go for a home loan, and your accountant will make sure that they're doing your finances in a way that you can actually get a home loan.
Yeah, I guess the accountant would be making sure that you're not switching business structures too much or messing around with things that could affect your trading or affect your ability to get a loan.
Yeah, well, sometimes, they might be deferring some tax to the next year by, helping you reduce your income now. And they can change that, and they can make sure that your income's good now. You're still going to pay the tax, but, they can put you in a position where you can get your home loan.
And if you're a business owner that's done some, let's say, creative accounting and not showing any income personally, that might be an opportunity to talk to your accountant and start getting some income on the books so that you can get that home loan.
Yeah, we should be mindful that, if we're paying for personal, things through the business, such as cars and, some of the house costs and stuff, the bank is still going to count those costs as normal costs when they do your home loan. So you've already paid it through the business, but then the bank's going to count it again through their actual home loan application because they're required to by APRA. And so that's where some business owners will go down the path of doing a low doc and pay the extra interest.
Yeah, great question, Jamie. Hey, next one's from Luke, and I feel like this is going to be a popular one that we should hit for all first home buyers. The question is, what kind of government schemes are out there at the moment that can help first home buyers? There are a couple out there. Hey, Archie.
Yep. So the first thing is, if you're a first home buyer, we've got the stamp duty concession that applies for properties up to $550,000, and that's quite a saving. In money that you would have to come up with up front when you don't have to pay that stamp duty. The second one is an actual grant, where you're given up to $15,000 there towards building a new home or buying a new home that hasn't been lived in yet. The third one, which I find is really helpful, is the 5% deposit scheme. So it's a first home guarantee. And so you come up with 5% deposit, and it's a special loan. So there's 50,000 spots available through those loans, and so basically it means that you don't have to pay mortgage insurance. And mortgage insurance is an insurance for the bank, not for you, because you're coming in with a low deposit. The bank wants to ensure that they're protected, and they'll get you to pay that insurance to ensure that they have that protection because your deposit's low. So this scheme is basically backed by the government, and the government's saying that if anything goes wrong, they'll pay the bank whatever money they might lose.
And LMI for typically under 20% deposit, over 80% LVR, it can get pretty pricey. Hey, it can get up to $10,000, $15,000, even higher sometimes, depending on how big the property.
Oh yeah, it's all dependent on the value of the property. Yeah, the good thing about this scheme is that we've got a cap in Queensland of $700,000 for Brisbane for a property price, or $550,000 the rest of the state. So it gives you more flexibility to find a house at a good price. That's what I like about this 5% deposit scheme. Rather than trying to build or buy something new. There's also some regional home guarantee places as well. Then we've also got the 2% deposit scheme for single parents.
Yeah, this is a new addition. This is exciting.
Yeah, this one came out, I think it was a couple of years ago actually. But yeah, it's great for single parents, and it doesn't require you to be buying a first home. It could be your second home. So you could have had property before, but you're in a position where as a single parent, you want to buy a home, and the government's guaranteeing that you can do it on a 2% deposit, which is really nice.
Yeah. And there's about 10,000 places, I think, for that one. But this whole overarching first home guarantee scheme, there are about, I think it's 27 participating lenders in this scheme. So, and each of those will have caps on them. So I think you really just got to talk to a mortgage broker to see which bank would be best suitable, which lender I should say should be best suitable for you, and see if you can get in that place.
That's right.
And if the places fill up, they'll open up again next financial year. So you might just have to wait a couple of months.
Yeah, that's right.
Yeah, lots of great schemes. Go Australia. Got lots of helpful ways to get into your first home. Hey, Tegan asked a question. How do you know it's the right time to buy financially? Actually, she asked a few questions. How do you stand out as a candidate to buying a home? And also, is it wise to buy a home when things are potentially heading towards a crash or some kind of change in the property market?
Yeah, well, okay, so let's talk about the crash first. Again, bad news sells. So what's the media selling at the moment is a property crash. And I've heard this all my life, that we're heading for a property crash. And what I've found over time is that there are crashes in certain areas, basically due to financial crisis. So we tend to usually see these crashes more so in Sydney and Melbourne, in certain suburbs, and it's because of something that's happened financially. And stuff that's happened in the past is that people have lost jobs due to economic changes, and those people live in a certain area, and so once they lose their jobs, they find themselves in financial stress, and they're selling their houses. And then if there's a whole group of houses coming on the market at the one time, that's when we can see a crash. And we've seen property prices in Sydney and Melbourne drop 20-30% at times in certain suburbs, and then go back up again.
Well, I don't think we're going to lose jobs. We're at 3.5% unemployment, so we're the lowest in history. So would it take something else that would cause a local crash?
Yeah, we've also seen in the past where investors will pull out of an area, and they'll be looking at, again, the news or the media and seeing something's happening in an area. And, it could be that there's a major change in a company or a major change in defense or something, which is going to have an impact. And so suddenly the investors could be pulling out. So there's some reason for it. Back in 2008, 2009, when we had the global financial crisis, we saw some areas, drop in price by up to 50%, but they were also at a very much a high as well. And what happened there with that global financial crisis was again loss of jobs. So there was a big cut in middle management, and so all the higher priced properties took a cut. Lower priced properties didn't change. So because it was again dependent on who was being affected by what was happening in the economy.
Okay, so it sounds like you really need to look into the suburb that you're buying into and what are the demographics and things that happen in that area.
Yeah. So there's some areas, where, say Toowoomba as an example, Toowoomba's economy is made up of defence, education, agriculture, manufacturing, services, health. There's just such a big
There's a diversity in Toowoomba, yeah.
Diversity, yes, in Toowoomba, which keeps the economy quite stable.
Yeah.
And so it keeps house prices quite stable.
Shout out to Mayor Antonio if you're listening.
So that's like you said, that's where you got to look at the area and what it's being affected by. Whereas we've seen other places, other areas such as say Noosa, in the 2008-2009 global financial crisis, Noosa property prices went right down because it became a ghost town. There was just virtually no one there.
Yeah, I remember what saved it was Kevin Rudd actually opening it up to international buyers. So basically, the only reason Noosa recovered was people overseas swooped in and bought up those homes.
Yep. So again, the government does work on trying to keep house prices up.
Yeah.
What else we got there in that one? When's the right time to buy? The right time to buy is as soon as possible, really, because you need time to pay off your home. And, and especially if you're, in a position where you can actually jump in and pay your home off quickly, that's a good time to buy and get in and start paying it off.
Okay, great question. Thanks, guys, for sending these questions in. And if you want to send us a question about anything, just go to waymakerpodcast.com.au and or just message us on Instagram, Waymaker Finance. Matt asks, if one partner has a terrible credit history, can you leave them off the mortgage but add them to the title? Sounds like a question for a friend.
I have had this only once before, and we found that the banks didn't want the person with the bad credit history to be on the title. And there's also an APRA ruling, where we should, for the person to be on the title, they have to have an interest, in the loan as well. And so, so the banks are pretty particular about this, that, if that person shouldn't be on the mortgage, then they shouldn't be on the title. And it's probably safer that way anyway, if someone's got a bad credit history, because you don't want, someone being declared bankrupt and then, losing your house over it.
I also had a friend ask me this week about equity. So I'm going to throw this question in. Do you need to get your home revalued or refinanced before you can actually access any of your home equity?
Yeah, this is an interesting one. I feel like people think that this is free money, but it's not. Because let's say your property price went up by $100,000 and you want to access that $100,000, you are going to need to borrow that $100,000 against your house, to access that money.
I think this is where people get tripped up. They think they can just grab the money and it's just there, but they do have to actually refinance, right? They have to increase the amount that they're borrowing.
Yeah, you've got to increase the amount that you're borrowing. It's quite often talked about as a strategy for buying investment properties, is use the equity in your home. And I've seen this go really wrong. I've actually seen people lose their home because they use the equity of their house to buy an investment property or several investment properties. And they found themselves in cash flow problems and, again, loss of jobs. And, they found themselves being forced to sell, and it had a big impact on them, and, even losing their own home and the equity that they had in their own home.
Yeah, that kind of answers the next question and the last question that we had, which was around using equity to buy investment properties, but for the purposes of, getting tax deductions to maybe pay off your own principal place of residence. And, we said this, I think, before on the show, that things like investment properties need to be done with proper advice, because if you don't do it well, you can land in trouble. You can land in a world of trouble, especially around cash flow, if you can't service that property for the 15 or 20 or 30 years that you want to hold it to get that long-term return. So what are some other things that people need to be aware of in this space before we close out?
Yeah, the more complex something gets, such as investment properties, because now we're talking, we've got to pay higher stamp duties. There's much higher costs to move into an investment property that you've got to pay for. And now we've got tax issues as well that have to be taken into consideration. So when you're starting to look at something more complex, you're talking a lot more risk, and you really need to have your professionals on board. So you that's where it's going to be so important to have mortgage broker, buyer's advocate, tax accountant, to work it all through and come up with a really good strategy, because the strategy is going to be critical here.
You probably need to have your spouse on board too, because I've seen a lot of people just jump out and do this stuff, and it can cause some pretty big tension in a marriage.
Yes.
You don't have that other person really understanding and agreeing with something as big as an investment property strategy.
Yeah. And look, the tax benefit might only be, say, $3,000 for the year, and you might have had to have spent $50,000 or $100,000 to get that $3,000 tax benefit, but it's only a tax deferral. It's just deferring tax for a little while. It may not actually be any money in your pocket. So this is where it gets quite complex and quite risky, because you could find yourself without the flexibility to be able to change when your circumstances change, and you can end up losing quite a lot. So well worthwhile checking that out. There are other systems, that I use as a financial planner, which carry way less risk and way more flexible, especially for families. And one of those is Mortgage Crusher. And we use that system because we're quite risk averse, and we'd much rather see people win than to see people take a lot of risk and lose.
Yeah, it's well worth pointing out. Our last episode was with Matt Tembo, buyer's advocate. So in purchasing an investment property is one big challenge, and you'll want to get that right. But you also need proper advice to make sure that investment property is going to work correctly and not be a drain on your cash flow, and that you've got the adequate income and you're happy with the limited flexibility, I guess, the short-term pain to keep that property in service at, just to make sure that it's going to work for you and your family. Otherwise, it can cause a lot of stress. And Mortgage Crusher is something that we're going to talk about on next week's episode as well, because it is a great strategy that I think our listeners will love learning more about. And so let's park that there. And next week we're going to talk about Mortgage Crusher as a strategy. This is a strategy that you do need a financial planner, one of our wealth partners, to implement. But it's an amazing system that allows you to pay your home off in 10 years or less. So that's pretty cool, and do so in a tax effective way. So we're going to be chatting about that next week.
Looking forward to it.
All right. Well, until then, guys, thanks for sending all your questions in. Thanks for answering them, Archie. This was 2 episodes this week we got out, actually. We're on a bit of a roll here.
That's good. Yeah. It's probably because I went on holidays, come back refreshed. I doubt it.
Thanks, Archie. See you next week, guys.
Thanks, Lachlan. Bye, everyone.
And just a reminder that everything we discussed today is for education purposes only. It does not consider your personal financial situation or goals. So if you'd like to speak to someone about your personal finances, you should head to waymakerpodcast.com.au, and we'd be happy to connect you with a qualified advisor. Thanks as always for listening to Mind Over Money. We hope you have a fantastic weekend.